a good intro, man. I like that intro. How you doing today? Welcome to the Doe Show. My name is Dustin Tibbetts. I'm a financial advisor with jazzWealth Managers. If you've never heard of us before, we're financial advisors that work with the beginner. We work with the retiree. We work with everybody. We don't care how much money you have, whether you're just getting started, you're very beginner, or whether you're almost to retirement or in retirement. We are fiduciary financial advisors. And that's about all I'm going to have to say about us today. We're going to talk about getting your dough straight today. And part of getting your dough straight is understanding some of the lingo. Now, you can see on the board there that I've got a lot of words. We're going to go through them rather quickly because I don't want to keep you here forever. But here's how this goes. So you may find that you are trying to get your dough straight by investing for yourself. You may be trading for yourself. You may be doing long-term investing, short-term investing. You may be looking to invest for your kids or save for your kids and their future. Any way that you're trying to get your dough straight, I'm trying to cover some of those names today. So what we're going to do is go through them for you, and I'm going to erase them as we go. Are you ready? If you have any questions, by the way, and you're watching this live, hit me on the chat there. Mutual funds. So mutual funds are just a basket. Right? The fancy terminology is they say it's like it's a pooled investment vehicle and you put your money in there and you're able to spread out amongst a bunch of different stocks. But in reality, mutual funds are just a basket. And so you're paying somebody to throw stuff into that basket, stocks, commodities, whatever they may be. As they put stuff into that basket, the basket either grows in value or shrinks in value. It'll fluctuate over time. And so that's what a mutual fund is. Now, there is a cost to have somebody throw stuff into that mutual fund. There's a fund manager. There's advertising expenses, office expenses, and whatnot. Actually just looked at someone's fund today that had, we're going to go over the terms, had all kinds of fees built into them. That does happen from time to time. But a mutual fund is essentially just a big basket. Now, mutual funds can be specific to a asset class or a sector of the market. So you can say, and you really do hear a lot, where it'll say large cap fund, right? We'll leave a name out, but it's large cap fund. And those invest in large cap stocks. It may be that it's the NASDAQ, right, mutual fund, and it invests in the NASDAQ. It may be called tech or something. There's commodities, there's bond mutual funds. So we'll get to a little bit of that in just a second. Exchange traded funds are very much similar to mutual funds. So exchange traded funds are a pooled vehicle. They're the same basket. You could throw stuff in it. The difference is you can buy and sell exchange traded funds from anybody. Mutual funds you can only buy from the mutual fund company. So for example, if it is the Fidelity Tech Mutual Fund, I tried to name one that didn't actually exist so I don't get in trouble. If it's the Fidelity Tech Mutual Fund, you can only buy it from Fidelity, and you can then only sell it back to Fidelity at whatever the price may be. An exchange-traded fund is trading right now in the market, back and forth, wiggling around, and buyers and sellers from all over the world can exchange the shares. So exchange-traded funds are more liquid. They also tend to be less expensive. Many of them don't cost you anything at all. And exchange-traded funds also can be broken down into sectors. You could see a gold exchange-traded fund. In fact, every day on the closing beat, I go through a lot of exchange-traded funds when I talk about what gold did and what oil did and retail stocks and things like that. We cover those in there, so maybe something to check out. All right, index funds. Index funds can be exchange-traded funds or they can be mutual funds. So not to confuse you, but you have two products. You've got mutual funds and exchange-traded funds. Now, those products can be, they have some that are index-based, which just means they track an index. So like we were saying a second ago, where mutual funds could be gold or tech, they might invest in retail, large cap, small cap. Well, they can also just invest in the index. Remember the NASDAQ example that I gave you. So exchange-traded funds, they also can do the same thing. They can be gold-related, oil-related, or they could just invest in an index. When you choose an index fund, whether it ends up being a mutual fund or an exchange-traded fund, you're essentially saying, I just want to participate with whatever that particular index does. Now, personally, I hate that because you have to pick the correct index. Most people think they're just following every index, and that's not true. If you pick the NASDAQ index fund, then you are performing with whatever the NASDAQ does. If you pick the Dow index fund, then you're going to perform with whatever the Dow does. So compare the two this year. The Dow has underperformed the NASDAQ. You're missing out. right? So I don't like index funds so much, but they're really designed for the person that wants to set it and forget it. They're happy with occasionally not keeping up with everything else, and they're like, that's fine, just whatever it takes, I just don't want to deal with it. All right? Now, hedge funds, and then we're going to stop with the funds. So hedge funds are for rich people. No other way to say it. I wanted to start a hedge fund a while ago, and I was severely rejected because the people that I wanted to join me were not rich enough. And so a hedge fund is basically a company where someone or some group of people says, listen, I've got a strategy that can just kill it. We're going to make unbelievable amounts of money. And you go, really? I want to invest in that. You give them their money, and the guy goes, well, here's the deal. If I do make a ton of money, then I want 20% of the profits, and I want to get paid 2% a year on the money that you have with me. And so that's what hedge funds are. And some of them can even have higher fees. Now, if that guy's really that good and he makes a lot of money, you don't care about giving him 20% and 2% or whatever it comes out to be because you made a ton of money. So hedge funds are for the ultra wealthy. The government actually mandates that. And hedge funds take different types of risk. They don't invest in index funds. They're using derivatives and futures and short selling stocks, which we'll get to. I believe it's somewhere on the list there. And so we'll get to that. Okay, REITs. I get this question all the time. REITs. What in the world are REITs? Stands for Real Estate Investment Trust. Although I only said 3 syllables there, or 4, it's actually 5. So REITs, Real Estate, R-E, Investment Trusts at the end of it. And what those are is basically when you want to invest in real estate, but you don't have enough money to physically buy real estate. Well, there are companies that say, hey, pool all of your money together. You got some money, you got some money. Go ahead, give me the money. And there's a manager or a group of managers, and they go out and they buy real estate, and you participate in their success or failure. And so real estate investment trusts are required to pay out almost all of their profits in the form of dividends. So I can always tell when somebody's not familiar with dividends because when they'll say, hey, Dustin, this stock pays a 12% dividend. Should I buy it? And then they send me a list of like 50 different stocks that pay high dividends. And I go, yeah, you could buy one of them, but they're all doing the same thing. So you're really riding in one space there, kind of putting all your eggs in one basket. So what you should know is the REITs are not all the same. Some companies buy commercial real estate, meaning they buy shopping centers or they'll buy the strip malls and things like that. And then other real estate investment trusts might buy hotel properties. It could be hotel operators. It could be the companies that supply the building to the hotel operators. It could be residential real estate, or it could be a mix of everything. So you really want to look at these REITs if you're considering them and see where they're investing. What is it that they're interested in? But that's a way to start. You could put $1 in and you can invest in real estate without really actually touching the real estate. So that's that. Let's do asset allocation next. So that's just a fancy way of saying, hey, how about putting 60% of your money in stocks, right? How about putting 10% of your money in bonds, maybe some real estate, right? Let's just, for lack of a better example, let's use that, right? So that's asset allocation, taking a percentage of your money and putting it in different asset classes. It could be real estate, bonds, stocks, it could be gold or commodities. Those are different asset classes. And so there are lots of theories about how to break up your money over different asset classes to make the best return on your money. So that's what asset allocation means. RIA, what's RIA mean? Registered Investment Advisor. That's what we are at jazzWealth. So registered investment advisors are companies that basically charge money to invest on your behalf and give you advice and help you along the way. That's exactly what we do. We're registered investment advisors, and advisors can be registered either in individual states, like for example, we're registered here in the state of Florida, or they could be registered with the SEC, being globally. Hopefully in the next 2 weeks we will have that answer. We're trying to register with the SEC right now, although I'm not allowed really to say anything else. Okay, fiduciary. What's a fiduciary? This one comes up a lot. I get this question a lot. A fiduciary is, in the most general sense, put the business aside, a fiduciary is someone who agrees to put your interests and your benefits to the highest possible power, meaning they put your interests ahead of theirs. And this could be in the legal space, it could be in my business, the financial space. It just means that when you tell me you're looking for something, I will give you the best possible advice. I will not steer you in a direction that costs you money when it's not necessary. I will not steer you in a direction that is bad for you when it is not necessary, okay? A good example is a company called Primerica. So when you go to Primerica and you say, I would like to invest in a mutual fund, they are going to sell you the most expensive mutual fund possible. I just did another review of a fund today. Lucas can attest to this. Where the mutual fund was by far the most expensive mutual fund the person could have bought. They are not fiduciaries. They are not required to act in your best interest. They are in business to make as much possible money as possible. Like, I don't know if that's wrong for them. I disagree with it. Something I can't do, but we are fiduciaries here at jazzWealth. Okay, let's finish up the blue ones. Custody. What does it mean when we say custody? So there is a custodian account, and then there is a custodian. Oh, God, I'm so horrible at that. Okay, so a custodian account, that means that someone is acting as the holder of the investments or the account on behalf of somebody else, typically a minor. So what's very popular here is a UTMA account. This is a custodian account. And what that means is you are opening an account for a child that's not of legal age yet, and you are choosing investments or how to manage that account. When the child reaches a age of adulthood, some states it's 18, some states it's 21, however, it cannot be over 21, then that child will essentially now take over custody of that account. Careful. Be very careful here. When people ask us about 529 plans, I usually say, hey, consider the custodian account as well. There's some pros and cons there, but we should weigh them. Be very careful here, because I can tell you an actual story where a parent opened a custodian account for their child and bought stocks. Over the course of many years, while that child was young, they bought stocks and the account grew. The child had medical expenses that the parents could not afford, and therefore the parents took money out of the custodian account to pay the medical expenses. Doesn't sound like a big deal. It sounds like the parents were doing what they had to do to take care of the child. The child sued the parents for taking from their custodian account, and the child won because the custodian was not acting in the best interest of the child. They were acting in the best interest of the parents, not having to pay a medical bill. That was a horrible story. That was some drama. I was on the other side of that. I thought that that kid should have been like banished from the world. But anyways, that's what these are. Now, a custodian is a brokerage firm that holds accounts for whoever it may be. We use Folio, not Folio Investing. We use Folio FN or Folio Institutional for our custodian. What they do is they hold the investments, they make sure that nobody touches them, everything's good, and then they do all the reporting, the tax reporting, the trade reporting, things like that. They basically handle everything for us. We do the management of everything. They do all that garbage work that nobody likes to do. That's a custodian. Another example of a custodian would be Fidelity. Primerica is a custodian, although they sell garbage. Okay, let's move on to some of the fun stuff and then we'll wrap this up here. What is margin? So if you're a trader, margin means you are borrowing money to invest or trade. If you had $5,000 in your account and you were trading, I don't know, stocks or whatever, and you asked your brokerage firm for margin, they would give you another $5,000. So you would have a total of $10,000 that you could invest. They just give you that. You pay a small, insignificant amount of money to have that $5,000, but you have to remember that's not yours. If you then go take money and you spend $10,000 on some stock and the value drops to, say, $4,000, you're in big trouble, because they are going to say, it's only worth $4,000. That means you have no more money and you owe us $1,000. So margin is a double-edged sword, as they say. You can borrow money to invest or trade. Day traders use margin religiously. They have to by law. And so margin can be good and it can be bad. Maybe we should do a whole video on that. Okay, Roth IRA, most of you already know that. Those of you watching, Roth IRA is a post-tax account. You put money into the account and it is never taxed again. Now, you do not get taxed up front when you contribute. I get this all the time, by the way. people ask me, Dustin, I put $1,000 into my Roth IRA. When do I pay the taxes on it? You've already paid the taxes on it because that was income that you made from your paycheck. So therefore, any growth, anything that happens in the future is all tax-free. I highly, highly suggest most of you look into a Roth IRA. There's only a few limitations if you have like high income, things like that. Short selling. Short selling comes up a lot. People ask me this question. Well, here's how it goes. When you buy a stock, let's use Apple as an example. It's $1 trillion in market cap today. If you buy Apple and you no longer want Apple, what do you have to do? You have to sell Apple, right? That's the transaction. So in order to start a position on Apple, you have to buy it. And in order to finish that position, you have to sell Apple. Well, if you wanted to bet on Apple going down, you would start by selling Apple. Wait a minute, Dustin, I don't own Apple. How can I sell something I don't own? Doesn't matter. You start by selling it. If the stock drops, you make money. If the stock goes up, you lose money. At the end of this process, when you want to be done with the position, you buy back Apple. And that's the equivalent of short selling. It means to profit from a stock's movement on the downside. You are borrowing shares from somebody else to sell, and you hope that you sell them at a higher price than what you would eventually buy them back for. Bit of an advanced topic there, but that is what short selling is. Okay, bid and ask. Man, I should have used like 2 videos here. Okay, a bid and an ask. What is that? So when you look at stocks, unfortunately, a lot of you use Robinhood, and it's not so good, not so clear there. Let's say you're looking at a stock and the stock's worth about $100. There will be people, just like in the normal world when you're trying to sell a car, there are people that want to buy the car for $100. However, there will always be people that are not willing to sell for $100. They may be willing to sell for $101. And so this is the bid and the ask. Imagine people standing in a room and I'm going, I'll buy for 100. This is actually how it used to work. I'll buy for 100. 100, anybody? 100, 100. And meanwhile, on the other side of the room, people are going, I'm selling for 101. 101, 101, and we're just yelling back and forth. 101, 100. 101, 100. 101, 100, right? And that's how actually stocks used to be traded. And at some point, somebody goes 150, right? Or 100 half. And then the other person over here is going to go, close enough, done, deal. So at some point, the people that are asking 101 may drop to 150, or these people may raise their bid and they may say, all right, I'm willing to pay $100.50 or 100 half. The other people go, okay, fine, that's good. I wanted 101, I'll take it, sold. And so that's the bid and ask. You can actually see this happen in real time on most platforms, and it happens lightning fast. Lightning fast. So something to take a look at there. Dividend yield. What's a dividend yield? Well, we sort of talked about it a minute ago, but dividend yield, you're going to see 2 numbers. You're going to see the dividend paid when you look at a stock, and you're going to see the dividend yield, right? Now, dividend is the number that they pay out. So maybe the stock pays out $5 in dividends, okay? The yield is the percentage that they pay out. So you're looking at both of them. Let's say the stock price was $100 a share, just to make it easy for me, and they paid out $5 in dividends. We would know that the dividend yield is 5%, right? So you look at a stock and you go, Dustin, it pays out 5%. You can look at the stock price real quick and go, that's $5. Maybe that's a deal to you. I don't know. So that's what dividend and dividend yield are. Bull market, bear market. You guys know this one, right? Weren't you taught this in high school? A bull market, picture a bull with horns, and the bull rams itself into objects in a sort of upward moving way. That's a bull market, meaning upward, everything's trending nicely. And a bear market, the easiest example of that is when a bear takes its claw, it swipes down. And so when the bear swipes down, now think of that, that's a declining market. So bull market up, bear market down, really simple. All right, market cap. Today is a fitting day to talk about market cap because Apple hits $1 trillion in market cap today. The first company to ever be worth $1 trillion. How'd they come up with that? Share price. We talked about this on the closing beat yesterday. The share price needed to be around $207 times number of shares outstanding, right? So when you take any company and you look at the current price, times it by the number of shares that they have, that gives you the market cap. And today, Apple's market cap is $1 trillion. They have officially become the first company to do it. Okay, a couple others and we'll be done. Rollover IRA. Whenever someone wants to roll over a 401k, I always say, okay, well, you go to the website, you click 401k. Now, we made it easy. We changed the way we word it. The first question that's asked when you open up an account is, what type of account do you want to open? For a while, we had rollover IRA there, and nobody understood what that meant. We've since changed it to 401k rollover, and everybody gets it. It's a piece of cake. A rollover IRA is just a traditional IRA. There's nothing else to it. But we code it as a rollover IRA. So when the money comes over, when you roll over an old 401k, when it comes over, we know, the custodian knows, and the IRS knows that that is rollover money and it is not a new deposit. See, if we didn't code it that way, then let's say you rolled over $40,000, the IRS might think that you deposited $40,000 and that would send off a bunch of red flags. So a rollover IRA is simply a traditional IRA, and a traditional IRA is a retirement investment vehicle, individual retirement account where you can invest for the future. You pay tax on anything when you get to retirement. All right, front load. A front load is a charge that mutual funds charge when people that sell them are not fiduciaries. Primerica is a great example, mostly. They sell mutual funds where for every dollar you put in, they're going to take some of it from you right away. So for example, if you put $100 in and the front end load is 5%, for every 100 you put in, they're going to take the first $5 as a fee. There's also a management fee, a 12B1 fee, and annual fees as well. So front load mutual funds almost never make any sense, although they have great sales pitches, by the way. I attended a class one time where they were teaching these people how to sell front loaded mutual funds. It's slick. Boy, it's slick, the argument they make, I'll tell you, be careful. And finally, capital gains and capital losses. So if you buy a share of stock at $100, it goes to $105. You then have a profit of $5 per share. Let's say you only bought one share. You have a $5 capital gain. Now there's something called long-term, come on, man. Long-term and short-term capital gains. These are different. If you have an investment account that is not retirement related, this $5 could be a long-term capital gain or a short-term capital gain. A long-term capital gain is 1 year plus 1 day. How about that? And a short-term capital gain is 1 year or less. What does that mean, Dustin? If you bought the shares for $100 and the next day you sold them for $105, good job. You made $5 a share, but you held it for 1 year or less. And so you're going to pay short-term capital gains. Short-term capital gains count as income. So you add it to your income. May not be such a big deal if you're in the lower tax bracket, but if you're making good money and you're in the 24% tax bracket, then you're going to get charged 24% on your short-term capital gain. If you bought shares for $100, you waited 1 year and 1 day to sell it in a normal account, not a retirement account. You waited 1 year and 1 day or 2 years or 5 years or whatever, and you had a $5 profit, then your long-term capital gain is a flat tax. It is either 0 or 15% currently. Now that might change. We'll see what happens, but that's what capital gains or losses are. Now, let's say you bought this stock, you sold it 10 days later. All right, so this was a 10-day trade. And then while you were holding that trade, you bought a stock for 90 and it went to 85. That's a $5 loss, right? And let's say you held that trade for 10 days as well. Okay? Now, at the end of 10 days, you have a short-term capital gain, counts as income, but you also have a loss of $5 that's equal to that. Well, the IRS says you can basically cancel them out, right? As long as they're not the same trade, you can cancel them out. And so you'd end up with no capital gains. Very important. We do this really well here. If you have a taxable or an individual or a joint account with us, when you need money and you need to sell positions, we literally go through all your positions and say, okay, let's take off a little bit of gains and a little bit of losses. So at the end of the day, you get your money and you don't owe any taxes. Really, really fun. That's something I would say we're really, really good at. Woo! Okay. That's a long one. Okay, so let's see if there's any questions that I missed there. Is Costco a good stock for a Roth? Any stock can be put into a Roth, but as far as making a specific suggestion, I am only allowed to do that for customers. Not my rules, I'm sorry. But yes, you can put any stock into a Roth IRA as long as the brokerage firm allows it. It's not there's no problems there. Yeah, a lot of words to learn. That's okay. I'm sorry. This was a long one today. Who has the best CD rates right now? No idea. Here's the thing. We're at a point where you should look at short-term notes, T-bills, high-interest savings accounts, and compare them to CDs. CDs require that you leave the money in there. They are now starting to get to a point where you don't need to lock up your money to get the same return. You might be able to do it with bonds, with notes that are in really short term. You might, because those are still sort of liquid, but they're guaranteed. High interest savings accounts, sort of similar there. You might want to look at some of the options that are out there. It hasn't been that way in a long time, and it's starting to get better and better. Robinhood has extended hours now. Yeah, I mean, Robinhood has its own group of customers. Extended hours, all that stuff, it's nothing new to the trading world, but Robinhood's done a good job to make it seem like, hey, look what we have, look what we're offering. Robinhood's really for that very, 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 very beginner. And it's a good one. I'm not arguing with it. I think it's a good one. M1 Finance, also good, yeah. They should make small cap, large cap, super cap is next, right? 1 trillion. The problem is it would only have one stock at the moment. No problem. All right, guys, well, I'm going to wrap it up there. I know we made this one a long video. Hope it helped you in some way. If it did, hit the subscribe button, turn on the bell. That'll let you know when we go live later for the stock market update. We call it the closing beat here. We'll certainly be ready to do that, and we'll see you later.
Why should you choose jazzWealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.